Let's talk to Marc Ostwald. He's a strategist at ADMISI. Very good morning to you, Marc.
Good morning.
What an exciting time to be in the markets.
Well, it's certainly a lot more interesting than the drudgery of low volatility, low volume trading that we had last year. Markets, I think, gradually waking up to the fact that the Fed is actually very, very serious. And for all that they've learnt a different response in previous years, they are now getting on board with the Fed. I think the part which probably surprised them yesterday was less the fact that the Fed still stuck by its rate trajectory, which basically assumes 3 rate hikes this year, and more the fact that in the star forecasts, if you go through the bit where they were briefed about the star forecasts, they noted that they expected the dip in inflation that we've had over the past 6 to 9 months to be something which is very transitory, and they're far more confident about that. Before, they were saying, well, it'll probably be that. That was the message under the Yellen Fed, and there wasn't a great deal of certainty, but they didn't feel like they had to pay much attention to it. Now they're talking about, well, the key factor this year is the core PCE deflator, which is what the deflationistas on the FOMC, who we now know also are a very, very small group. Whereas they used to be basically the majority, now they form just a couple of people who are worrying about it. So we don't really have to, we'll still hear from the likes of Kashkari and Bullard.
So deflation is absolutely dead?
Yes, for the time being, So the market has now, having been in December, discounting 2 rate hikes against the Fed's 3 rate hike scenario, on board with the Fed. That's the simple reaction.
Okay.
And we've got a response in bond yields, 10-year yields now sort of knocking on the door of that magic 3% marker, which I think a lot of people see as a line in the sand. I think there's 2 different scenarios here, and it really depends on the reaction function of people investing in the non-government space there. We've taken down the supply that we've had this week, all $258 billion of it, pretty well, to be honest. But we've still got this scenario where you look at corporate bond spreads and, above all, emerging market bond spreads, foreign currency ones, i.e. the ones in the dollar space. And they seem to be remarkably impervious, but it depends what you look at. We've tightened in the emerging market bond spread after we had that little whoopsie when we had the equity market turmoil. But that's one story. That tightened back in again. There's a lot of enthusiasm. We had an issue for Kenya yesterday, which is in deep trouble. Its standby credit line for the IMF has been put on ice for the time being, and yet they can bring 10 and 30-year paper, admittedly with a handsome premium, easily, and they get a book of about 11 billion. So we've still got a lot of people with a lot of money to go into corporate bonds of all ilks, investment grade, high yield, emerging markets. But we're also starting to see some telltale signs, and to me this is the worrying point, because as much as that spread has tightened back in again, we've also seen the emerging market bond ETF, run also by JP Morgan, tailing off quite sharply. So somewhere along the line there's going to have to be a meeting of minds there, because it makes no sense for emerging market bond spreads to be tightening at the same time as the ETFs are actually falling in price. So there's a little bit of a matchup. My suspicion is that what's happening is people know that whether it's corporate bonds, whether it's high yield bonds, whether it's emerging market bonds, if they were to test the liquidity in the market, test the bid, above all in this overly regulated world, the consequences might actually be quite dire. So I think a lot of people are basically hedging their books while selling the emerging market bond ETF. But that's only a game you can play for so long, and it's based on the assumption, oh, well, this is just a passing phase and the enthusiasm will remain. We shall have to see. If we start to get a response in corporate bond yields, then I think that level at 3% in 10-year terms is probably quite a significant line in the sand, because if you start to see spreads widening and prices falling in the broad corporate arena or non-government arena, then you will start to see a bit of flight to safety. Notably, of course, we are in a situation where those short-dated yields in the US look very, very attractive. 220, when you then look at it and compare it with the Eurozone, particularly the Eurozone high-yield area, you're actually looking at a situation where you can pick up selling high-yield corporate euro-denominated debt going into the short end of the US Treasury market. Now, somewhere along the line, however much the US is borrowing, that is out of sync. So if we go to the next table, because I think a lot of the strength that we've been seeing in the euro has been predicated on this idea that the Fed game is over. We know the Fed's going to be tightening policy. What we want to know now is not only when the ECB is going to end its tapering, which most people assume is going to be at the end of Q3 this year, but when will it start hiking rates? Well, mid-January, as you can see in the white line on the bottom chart there, we were at the point where we were starting to discount, not fully, an ECB rate hike by the end of the year. In the meantime, we've started to price that back out again. There's still a reasonably high probability there, but I think this is critical here, because if the ECB and less likely the Bank of Japan are going to be playing catch-up with the Fed, or are not going to be playing catch-up with the Fed, at least not for another, say, 12, 18 months, then we could have a situation where you've got another 3 or 4 rate hikes before they get their show on the road. And at that point, you look at the spreads that you can, the pickup that you can get out of euro area debt. Still a lot of negative yielding euro area debt around. You don't really want to be holding on to that. Going into US Treasuries, and it becomes quite compelling, regardless of the increased supply that the market's going to have to take down because of the budget, the much bigger budget deficit, and indeed the fact that the Fed is not taking as much onto its book as previously. So I think this is sort of the critical factor, and the critical factor also in terms of the dollar, because if the dollar starts to pick up, those people who are looking at the attractive carry levels into emerging markets are going to start having to question themselves more, because as long as the dollar is weak, then that carry looks marvelous. No question about that. It's not particularly large in a lot of cases, one would also have to observe. But you're in a situation where suddenly you've got the currency going against you because you're betting against the dollar, and suddenly it becomes slightly more uncomfortable. So testing times ahead, definitely an environment which is going to be more volatile, even if we don't get quite as much of crash bang wallop as perhaps some people are thinking.
On that note, Mark, thank you very much for your time.